Good evening, students. Welcome to the session. So, today what we are going to do is, today we are going to do the questions from the assessment of various entities topic. If you remember, I told you last time to revise and come. But any which ways, what we will do is, we will quickly recap. But if you have any questions around the earlier lecture, we had discussed the slum sale example. We had discussed a lot of capital gain examples and the problems that we had solved. So if you have any questions around that, I can take it up at this stage, or we can just quickly move towards the next topic and I can start revising and I'll give you the questions around the assessment of various entities. We are going to solve questions for the company, for how the MAT is calculated and all of that. For that matter, the REIT and all those examples, we are quickly going to deal with those particular questions as well in this particular class. So any questions that you have? If not, let's start with this. So assessment of various entities in the first class itself, if you remember, I had discussed about the tax rates of the individuals. We have already done that there is a default tax regime under 115 BAC. And if you want to opt out, you have to go for if you want to go for normal tax regime, you have to opt out of that. Similarly, for companies, you have 115 BAA, 115 BAB as the optional regime, and otherwise you have 30%, 25% tax rate if you have the turnover below 400 crores. Then for partnership firms, AOP, BOI, we have seen the tax rate is flat. For cooperative society also, we saw that we have 115 BAD, BAE, all of that. And similarly, for mutual concerns, we had also seen in the PGBP class, the 44A provision, which was there, and how it is, its income is not taxed based on the concept of mutuality, isn't it? Now, coming to the companies, for the companies, we have another one provision, which is the minimum alternate taxes. Now, in terms of the minimum alternate taxes, what is minimum alternate tax? You have to pay minimum this much percentage of the taxation in India. This is what is minimum alternate tax, right? AMT is applicable to individuals, Viraj, and the partnership firm. We will also speak about the AMT. Right now, we are talking about the minimum alternate tax, and then we will go for the AMT provision as well. So what I'm trying to here say is that the minimum alternate tax is applicable only on the companies. And for the minimum alternate tax, you should have to, basically in the minimum alternate tax, the concept is that if your total tax liability is less than the minimum alternate taxes, then you are required to at least discharge the liability under the minimum alternate tax, isn't it? So this is what the concept is. Now, this is applicable to all the companies which are there in India, including the foreign company also. But we'll see there are certain exclusions here which are applicable. So we'll see and talk about that. But for the time being, we are first discussing that the applicability of the MAT provision is under 115JB. Under 115JB, we have the MAT provisions which are applicable to the companies. So it says that in case of a company includes here both the domestic as well as the foreign company. Both are required to be there. Are we clear? So you have to do both the MAT is applicable, sorry, in case of both the domestic and the foreign company. What is the MAT rate? MAT rate is 15%. So MAT is applicable at the rate of 15%. If my tax under the normal provisions are less than, or the taxation under normal provision is less than 15% of the book profits, then in that particular case, the book profits shall be deemed to be the total income. So book profits will be deemed to be the total income. So therefore, if the book profits are deemed to be total income, then all the other provisions will be applicable to the book profits which are applicable to total income. What other provisions? So, for example, in case you have total income more than 10,000, you're required to discharge the liability through the advanced taxation, isn't it? So here also, under the MAT also, you have to discharge the liability of your taxation through the advanced tax. So advanced tax also becomes applicable. In case you have a liability under MAT and you do not pay the advanced taxes, then what would happen is you will have the interest applicability under 234B and C. So all the provisions which are applicable to total income would also be applicable to the MAT or the book profits, because book profits shall be deemed to be the total income. Now, when I said that the MAT is applicable to both the domestic company and a foreign company. So what are the exclusions under the domestic company? There are certain exclusions that MAT is not applicable in certain situations. Which are the exclusions? If you pay the tax, if you opt for the concessional tax rate under 115 BAA or 115 BAB, in both these situations, MAT does not apply. Understood. So remember, we solved one question in the last to last class also on this particular point, wherein we discussed that how in that question you were required to advise for the tax liability. So we calculated the normal tax, we calculated the MAT in that. However, the normal tax was more than MAT in that question, so therefore the MAT was not applicable. Then you also came upon the 115 BAA also, wherein you computed as per 115 BAA also, and then we concluded that the tax liability is lower in 115 BAA, so we should go for 115 BAA, and in that case, the MAT will also not apply. In case the MAT is applicable, then you compare that whether the MAT liability is higher or 115 BAA is higher, and then basically you decide and advise the client, right? So third exclusion is the life insurance business. For the foreign company, it is, as I told you, it is also applicable to a foreign company. But what are the exclusions for the foreign company? Foreign company is a resident of a country with which India has a DTA and it does not have a PE in India. So MAT will not be applicable if a company is a resident, if a foreign company is a resident of a country with which India has signed a DTA and that foreign company has a PE in India. Or foreign company is a resident of a country with which India does not have a DTA. But this company is not required to register under the Companies Act also. Meaning it does not have any business here also. Though not having any place of business here. So then even if we do not have a DTA, we are not required to register as per the Companies Act. Or the third case, foreign company whose total income solely includes the presumptive profits under 44B, 44BB, BBA, BBB, all of those sections and which are applicable for the shipping, airline, oil and exploration, all of that. And the tax has been paid in accordance with those sections, then in that case, the MAT is not applicable to that foreign company. Meaning if you're a foreign company and if you have a place of business here in India, then the MAT liability will be applicable to you. Now, what is the rate of MAT? MAT is 15% of book profit plus surcharge and cess. So, surcharge and cess here will be the same, which is applicable for the total income, which is applicable for the normal taxation. Here also 2% and 5% for foreign company and 7% and 12% for the domestic company, as it is applicable for the normal tax liability. Under the MAT also the same surcharge will apply. The MAT is 9% for units in IFS. Now, how do you compute the book profits under 115JB? Book profit starts with the net profit as shown in the profit and loss account prepared as per the Schedule C of the Companies Act 2020. So, it is going to remain the same. So, you will start with the net profit, what you have adopted in the P&L. Then you make the specified adjustments which are mentioned under explanation 1 to section 115JB. What are those adjustments? Income tax, you need to add back the provision for income tax or income tax payable. Now, income tax here includes the interest component also the surcharge and cess also. You have to also add back the deferred tax and you have to reduce any deferred tax crediting. Right? Then penalty is not to be added. Here what they say is income tax here means the income tax, surcharge, cess, interest. Penalty, there is no specified disallowance. So under the normal tax, you disallow the penalty under 37. But under the book profit calculation, since penalty is not a specified adjustment, you will not disallow the penalty. Then amount transferred to reserves, any amount transferred to reserve has to be added back. Any amount withdrawn from reserves have to be reduced. Provisions, if any, if there are made provisions for the other than ascertained liabilities, meaning for the provisions which are for unascertained liabilities, all those have to be added and any amount withdrawn from the provisions, if it's credited to the P&L account, has to be reduced. Then provision for losses of subsidiary company again has to be added back. Transfer to revaluation reserve, that you have to add back, and if you withdraw any amount and credit to P&L, you have to reduce. Provision for income tax, you have to add it back. Provision for diminution in the value of asset, you have to add it back. So all the kind of provision other than the provision for ascertained liabilities, you have to add back. Dividend paid or proposed, you have to add back. Depreciation, as per the books of accounts, which is there, that first you will add back, which will include the depreciation on revalued asset. But when you reduce it, you don't reduce the depreciation as per the Income Tax Act. Under the normal tax provision, you reduce the depreciation as per Income Tax Act. Here, you don't need to reduce the depreciation as per Income Tax Act. You will reduce the depreciation as per the books of accounts only, but excluding the depreciation on revalued assets. So what is the effect over here? We are just adding back the depreciation on revalued assets. But this is how the adjustment has been given over. Then notional gain or loss on transfer of share of SPV to a business trust in exchange of units of business trust, or notional loss on change in the carrying value of units. So we have to add back the loss, reduce the gain. So when the shares of the SPV are transferred to a business trust and in exchange you get the units of the business trust, so the notional gain or loss has to be added back or reduced, and the actual gain or loss has to be actually recorded. So you don't need to record the notional gain or loss. If notional gain or loss is credited or debited to P&L, you make the adjustment for that and actually record the actual gain or loss on the units transferred of the business trust. So when you transfer the units of business trust, at that time, whatever actual gain or loss will be, you will record that. Then income exempt under 10, 11, 12, you have to reduce that income and add any expenses on the exempt income. Then share of member in AOP or BOI where no tax is payable under 86. So you add that expense and reduce any income. Income of a foreign company from the capital gain on securities or interest, dividend, royalty, FTS, which is chargeable at the rate specified under Chapter 12, which is under 115A. So which are taxable at rates under the provisions of the Act. If that rate is lower than 15%, then you reduce that income and add back the expenditure. Royalties on patents chargeable to tax under 115 BBF, you reduce that income and add back the expense. Then brought forward loss and unabsorbed depreciation. So any unabsorbed depreciation which is there or the brought forward loss, whichever is lower, that has to be reduced. If either of them is nil, then no deduction will be allowed over here. Are we clear? So in that particular case, no deduction will be allowed. Now, in case for the companies which have gone into the insolvency and banking resolution, which have gone for that, so then in that particular case, what you need to do is, then you need to take not the lower of these amounts, but then in that particular case, you need to take the aggregate of these amounts. So meaning we have to take the UAD plus brought forward business loss. In case we have the company which has gone for the IBC resolution, then in that particular case, you need to take the unabsorbed depreciation and the brought forward business loss, which not whichever is lower, but the aggregate of that. Are we clear? For the all the other companies, we have to take the lower of the brought forward business loss or the unabsorbed depreciation. Are we clear? Yes or no? Any questions so far? Yes? Yes or no? Fine. Then, when you calculate your MAT, what is the rate? It is 15% is my rate. So when I calculate the MAT, the 15% is my rate. Are we clear? Then in case of the Ind AS compliant companies, in the case of the Ind AS compliant companies, we need to make the additional adjustments to the book profits. So items which are part of the other comprehensive income, which shall never be reclassified to P&L. You need to add all the credits and less all the debit. However, you will not make any adjustment for revaluation surplus or notional gain or losses from investment designated at fair value. Are we clear? What is OCI? What is OCI? Yes, other comprehensive income. Good evening, Namrata. What is OCI? Yes, accounts, Ind AS. OCI, no, Viraj, it's other comprehensive income. But what is OCI? So OCI is basically all the revenue, expenses, gains and losses that are yet to be realized and therefore are not recorded as a part of the profit and loss account. So OCI items which are there are not recorded in the profit and loss account. So for example, let's say for example, I have not sold the units at the moment, or I have not sold the shares till now. However, their market value is increasing or decreasing as on 31st March. So gains or losses from the change of value cannot be determined until I sell those securities. However, I can make the adjustments as per the mark-to-market gain or mark-to-market loss, and I can record it as a part of OCI. Are we getting that? So that is my other comprehensive income, which is not part of the P&L. Yes or no? So what they are saying is, under the MAT, in case of the Ind AS compliant company, in case of the Ind AS compliant company, what they are saying that any amounts which are credited or debited. So all the credits you add back and all the debits you reduce. However, we will not make any adjustments for the revaluation surplus, and for the second one is notional gains or losses. And for the notional gains or losses. So for that, we will make the adjustments when the actual amount is realized. So there are certain items that are not reclassified to P&L which are given under the OCL. For example, revaluation of plant property and equipment, revaluation of intangible assets, remeasurement of the employee benefit plans. So those are not reclassified to the P&L. Are we clear? So in that particular case, these are the adjustments which are to be made. Second is for demerger. So add any amount debited on distribution of non-cash assets to shareholder, less reduce any amount credited on distribution of non-cash assets to shareholder. Then you have to add the transitional amount. So what is the transitional amount? So let's say, for example, in the first year, you adopt the Ind AS from the normal accounting standards. So you have your books of accounts or your financial statements as per AS for the last year. But for this year, you are opting for Ind AS. You are adopting the Ind AS. So then in that particular case, you have to give the figures of the 2 years, right? For the comparison purpose, the previous year and the current year. So therefore, in that case, there are adjustments to be made. There are amount to be recorded in other equity as adjustments while adopting from AS to Ind AS. So any amount which is adjusted in other equity, excluding the capital reserves and security premium, and excluding the OCI items that are reclassified to P&L, because these shall be considered in the year of reclassification to P&L. And OCI items that are not reclassified to P&L, other than changes in revaluation, surplus of plant, property and equipment, gains or losses from investment in equity instrument designated at fair value, remeasurements of defined plan, translation difference of foreign operations. Other than that, you have to exclude. So meaning all of this you will include, and 1/5 of that particular amount you will be allowed the adjustment as a transitional amount. And lastly, add or loss gain on any disposal of foreign operations. So these are the additional adjustments that you need to make under the MAT. Now, in case you have the tax under the normal provision, less than tax under the MAT. So if you pay the tax as per the MAT, then you get the MAT credit, which is allowed to be carried forward for 15 assessment years. And that you can set off against the normal tax liability that you will have in the next year. So let's say, for example, in this year, I have 9.22 lakh. In the next year, I have 9.7. I have the MAT liability in the same year, 9.97 lakh. So I will go for the MAT, right? So 0.77 will be my MAT credit. And in the next assessment year, let's say my MAT liability is lesser than normal tax. So for the normal tax that I will pay, I will get the MAT credit. I will get the MAT credit to the extent of difference between the normal tax and the MAT liability. Are we clear? But the MAT credit will expire or will lapse when you convert from the company to LLP, or will not be allowed even in the case of amalgamation, or when you opt for 115 BAA regime. Are we clear, students? Yes or no? Any questions? Yes, any doubt, any questions? Shall we solve one question on this particular point? Yes? Any questions so far? MAT is clear. Now I'm giving you a question for that so that you can solve that question and give me the answer. It's a simple question, but it will have the important factor in place that you will have to convert the you will have to make a comparison, not convert basically. You will have to make a comparison in terms of the MAT liability, 115 BAA, and the normal tax provision. Are we clear? Okay, let's start with it. So the sum is surcharge applicable on MAT? Yes, Viraj, as I said at the start itself, surcharge is applicable on MAT. So ABC Private Limited, I think I'll just zoom in a little bit. Yes. ABC Private Limited, incorporated on 1/11/2023, is engaged in the manufacturing of footwear and has set up factory in Northeast. It has reported a net profit of 80 lakh for the previous year 23-24. Following items have been debited or credited to the P&L. Sorry. To the P&L. Contribution to the research association eligible for deduction under 35(1)(2). Expenditure towards in-house R&D 2 lakh. Depreciation as per books of account 40 lakh. Royalty received from patents developed and registered in India rupees 10 lakh. Expenditure on royalty 1 lakh. STCG on transfer of listed equity shares on recognized stock exchange 10 lakh. Other information is given. Asset acquired and installed or put to use during the previous year. Plant and machinery 1 CR. 20 lakh is paid in cash. Building is 50 lakh. Company has employed new employees to whom salary paid was debited to P&L account. Details of which are here under. So date of employment is given and number of employees are given. Salary per month is given and how the salary has been paid, that is also given. So yes, tell me now. First, we will compute the tax liability as per the normal tax provision. Okay. So first, we'll start with the net profit. Net profit is what? 80 lakh. Fine. Then contribution to research association eligible for deduction under 35(1)(2) of 2 lakh. What will happen over here? Yes, contribution to research association. Yes, faster. Contribution to research association. Whether allowed, not allowed under the normal provision. Will you add back? Will you reduce? Allowed as deduction. That's right. So under the normal tax provision, the contribution to research association will be allowed. So there is no problem to that. Okay. So we will not make any adjustments. So no adjustment over here. As allowed. Sorry, I will have to write it over here. Then expenditure towards R&D, in-house R&D, or let's do it simultaneously even for the MAT. So what about the contribution to research association? Whether you will allow this under the MAT provisions? Under MAT also, I will start with book profit. So whether you will allow under MAT? Yes. Yes, Namrata, correct. Yes, Namrata, that is right. Yes, what about math? Whether under math you will allow, disallow. Math allowed? Yes, that's right. So even under math, it is allowed. No, Viraj, it is not disallowed under math. Under math, only the specified disallowances are made. So here you will write no adjustment as allowed in normal tax plus math. What about 115 BAA? How about 115 BAA? Whether allowed under 115 BAA? Yes. Under 115 BAA, it is allowed or disallowed? Contribution to research association? Yes. Not allowed under 115 BAA. Yes, Viraj, you're right. So under 115 BAA, this is not allowed. So therefore, not allowed under section 115 BAA. So under 115 BAA, what I will do is, this is my tax as per normal provision. Under MAT, my net profit is again 80 lakh. And under the 115 BAA also it is 80 lakh. Contribution to research association. Here it is allowed. Here also it is allowed. But here I will add back the amount. What is the amount? 2 lakh. So here I will add back. Then what about the expenditure towards the in-house R&D? Expenditure towards in-house R&D. Yes. Yes, Namrata, correct. You are right. So expenditure towards the in-house R&D, it is allowed under MAT. It is allowed also under the normal provision. But what about 115 BAA? So this is no adjustment as allowed under normal tax plus MAT. What about 115 BAA? Whether allowed or disallowed? Yes. Under the 115 BAA, it is allowed. If you recollect, I told you under 115 BAA, if we go back to our class of the basic concepts. So if you look at here, What did I tell you? That scientific research expenses, which are in the nature of contribution to any university, research association for scientific research or statistical research, all of that is not allowed. But when you do scientific research expenditure for your own business, including the capital expenditure, including the prior to the commencement of business, all of that would be allowed under 115 BAA and 115 BAB. So this expenditure is towards in-house R&D, and therefore this will also be allowed under 115 BW. Fine. Then depreciation as per books of accounts. What we will do here? Depreciation as per books of accounts. Add back and deduct as per income tax. What about in MAT, Namrata? MAT, yes, allowed. Yes, Viraj, you're right. So under the depreciation as per books of accounts, under the normal provisions, we will add back. So here I'm adding back 40 lakh. Under 115 BAA also, I will add back 40 lakh. But under the MAT, only the depreciation on the revalued assets has to be reduced. Here we do not have any information about the revalued asset. So this is allowed under MAT. So under MAT, there will not be any adjustments. Disallow in normal tax plus 115 BAA. Are we clear? So here it will be allowed. Under MAT, there will not be any adjustment. How about the royalty received from patents developed and registered in India, rupees 10 lakh, expenditure on royalty, rupees 1 lakh? Yes. What will be the impact of this? Faster? What about royalties? Namrata, under the MAT, the depreciation is considered as per the books of accounts only. What we do is we just exclude the depreciation on the revalued assets under MAT. So we don't do under MAT, or we do not allow under MAT the depreciation as per the income tax act. Under MAT, we consider the depreciation as per books of accounts only. Are we clear? Yes, what about the royalties? The royalties, whether it will be allowed in the normal provision, how the taxation is there, we have already discussed that. Royalties are taxable, Namrata, but how will it be taxable? Yes, patents registered and developed in India. The taxability is given under 115 BBF. The taxability is given under 115 BBF. Royalties registered and developed on the patents developed and registered in India. So in that particular case, The taxability is under 115 BBF. This is at the rate of 10% on the gross basis. At the rate of 10% on the gross basis. Now, what will be the impact under MAT and 115 BAB? Yes. So just now I told you that under MAT you have to exclude the royalties which are taxable under 115 BAF. Isn't it? Just now we discussed. So therefore 115 BBF. So we will exclude the 10 lakh of the income from the MAT. So here what we will do is the royalties on patents registered and developed in India. Royalties on patents registered and developed in India. So here also what we will do is we'll reduce 10 lakh as this will be considered as separate business income. Here also we will reduce 10 lakh. How about under 115 BAA? So under the normal provision, I will write royalties taxable under section 115 BBF 10 lakh. And we will here add the expenses on royalties because this is taxable on gross basis, so no expenditure will be allowed. So 1 lakh will be also added. How about under 115 BAA? Yes, under 115 BAA, whether it will be taxable at 22% or whether it will be continued to be taxed at 10%. Yes. Yes, students, faster. So under 115 BBF, the taxability is 10%. Whereas under 115 BAA, the taxability is 22%. But 115 BAA starts with a non-obstant clause. It says notwithstanding anything contained in any other provision of the Act. If you opted for 115 BAA, the taxability will be at the rate of 22%. But then it also says it is subject to, so the provision under 115 BAA, if you recollect, I'll take you back. So if you see here, what did we say at that point in time? We said that it is saying that notwithstanding anything contained in any other provision of the Act, the taxability will be at the rate of 22% if you opt in for that, but subject to the income taxable at the specified rates under the specific sections will continue to be taxed at that rate. So income which are taxable at special rates at the specified rates under that, for example, 111A, 112A, 112, or for that matter, 115 BBF or any other income which is taxable at a special rate will be continued to be taxed at a specified rate under the Act. So even in that case, even if you opt for 115 BBF, if you opt for 115 BAA, even in that case, the royalties will not be taxed at 22%. It will be continued to be taxed at a special rate of 10%. So here also we will reduce the 10 lakh income and add back the 1 lakh expenses because this is going to be taxed at a special rate. Under MAT, it will not be taxed at all. Under MAT, it is going to be excluded. So MAT is not applicable on the royalties on the patents registered and developed in India. So we have completely excluded it from the MAT. Fine. Then STCG on transfer of listed equity shares on the recognized stock exchange, rupees 10 lakh. What will be done in that case? At what rate the STCG is taxed? Yes, faster. Reduce under normal and MAT STCG. No, Viraj, that's not correct. We have to reduce it under normal, fine. But under the MAT, this will not be reduced. Under the MAT, this will not be reduced. Are we getting this particular point? So under MAT, I'm not going to reduce it. I'm going to only reduce it from the normal tax provision because this is specifically taxed at the rate of 15%, isn't it? This is specifically taxable at the rate of 15%. So under the MAT, I'm not going to reduce it because under MAT, only the specified adjustments are to be reduced, students. Every adjustment which is there under the normal tax need not be made under MAT. Are we getting that particular point? Yes, under 115 BAA, we will also reduce it. But to say that it is also to be reduced in PNL, the answer is incorrect. So we will only reduce it for the purpose of 115 BAA and for the purpose of the normal tax provision. Are we clear? So here in this particular case, what will happen is you will only reduce it from the normal tax provision and under the 115 BAA. Under MAT, there will be the MAT still applicable on this amount. So therefore, STCG taxable under section 111A. How much is my amount? Amount is 10 lakh. So I will reduce 10 lakh here, no adjustment. And here also 10 lakh is to be reduced. So here I will put this under the head capital gain, STCG, taxable under section 111A, 10 lakh. Here also it will be 10 lakh. Fine. Then let's come to other information. Asset acquired and installed or put to use during the previous year. Plant and machinery rupees 1 CR. 20 lakh paid in cash and building is 50 lakh. So we'll calculate the depreciation over here. So depreciation as per Income Tax Act on the plant and machinery. Yes, what will be my depreciation? Not allowed on cash payment. You are right, Viraj. So 1 CR minus 20 lakh on 80 lakh. I will allow the depreciation. What is the rate of depreciation over here? Yes, it shall be 15%. You are correct. Will there be any additional depreciation? Yes. Will there be any additional depreciation? Yes or no? Additional for manufacturing. What is the rate of additional depreciation? Yes, 20%. You're right. So here, what will be my depreciation which will be allowed to me? Yes, what shall be my depreciation which will be allowed to me? Calculate please depreciation for me. Yes, faster please. So here it is going to be 80 lakhs into 15% and 80 lakh into 20%. So it comes to 28 lakh. Then you're right, Viraj. So it is going to be 28 lakh. 15% plus additional depreciation of 20%. Fine. How about the next one, which is building 50 lakhs? What shall be the depreciation on that? Yes, Namrata, you are right. Calculate the depreciation on building. Yes, students, please tell me. Yes, faster. This is not very complicated. What is the rate of depreciation on building? It is 10%, isn't it? This is 10%. So therefore, on 50 lakh, this is going to be my 5 lakh. Are we clear? Yes or no? So yes, you are right, Viraj. It is going to be 5 lakh. So depreciation on building, it is 5 lakh. So here we will reduce. What about under the MAT calculation? Under MAT, will we reduce the depreciation as per Income Tax Act? Yes. No. We will not reduce because we are considering the depreciation as per books of accounts. So here it will be no effect. Here also we reduce 28 lakh and 5 lakh. Fine. What is the next adjustment? It is for the deduction under 80 double J double E. So company has employed new employees to whom the salary was debited to P&L, details of which are given here under. So first we'll calculate the normal tax, yes, sorry, the total income which is there. Only then we can come to the deductions part. So what is my contribution to the research association? I have not added. So what is my total income coming to under normal provision? Please calculate for me. Is it coming to 88 lakhs? Are your answers coming like this? 88? No, Viraj, how 68 is this coming? It should not be 68. Yes, I've written all the points here on the screen. You can just compare once. You're not adding back royalties and capital gains, so that is part of total income, Viraj. So that also needs to be added back. That needs to be added back. Yes, is it coming all the answers? Then what about my deduction under 80 double J double A? Yes, what will be my deduction under 80 double J double A? Let's compute that. Yes, students, please compute for me what is the deduction under 80 double J double A. Faster. So, first one, account paid check, 18,000 is paid to employees. Whether this will be allowed for 80 double J double A? Yes. Whether this will be allowed or not under 80 double J double A? It is paid by account paid check, 18,000. Yes, allowed. So we'll take that. Next one is 4 employees to whom 25,000 is paid by ECS. Whether that is allowed? Yes. Allowed 25,000 for ECS. That's right. So next one is 28,000 by check. But 1 second. In 25,000 by ECS, the date of employment is 1/12/2023. So, for how many days the employees should be present? Even though this is 25,000, which is lesser than 25,000, less than equal to 25,000, but for how many days the employees should have been there? Yes. How many days the employees should have been there? 240 days. No, Viraj. Please look at the question once again. It will not be 240 days. What is the question saying? You have to read the question carefully. ABC is engaged in the manufacturing of footwear. For footwear, what is the deduction which is available? For footwear, sorry, for how many days for under footwear are considered for the eligibility of 80 double J double A? How many days I should have been employee for 80 double J double A for footwear industry? So if you look at 80JJAA, it says that employees should be employed for 150 days if you are engaged in the manufacturing of apparels, footwear, or leather products. So, in case you are into the manufacturing of apparels, footwear, or leather products, the number of days will not be 240 days, students, it will be 150 days. So you have to be very careful when you read the question. The question here specifically provides to you that the assessee is engaged in the manufacturing of footwear. So here, since this is whether this is satisfying the 120 days, 150 days condition, how many days you are coming to? Yes. Whether this is satisfying 150 days, answer is no. So here, this year 80 double J double, sorry, 80 double J double A not available since employees present for less than 150, since this is a footwear industry. Now this will be allowed to me. This will be allowed to me in the next year if the employees in the next year are present for 150 days. So in the next year, if my employees stay with me for 150 days, so this will be available in the next year. So this or deduction shall be available in the next assessment year if employees present in next AY for greater than 150 days. Are we clear? Yes. Next one, 28,000 by check. Whether this will be allowed? Not allowed. Yes, Viraj, because it is more than 25,000. So here also 80 double J double A not available as salary greater than 25,000. Last one, 25 employees, 11,000 in cash. Whether this will be available? Yes. This will also not be allowed because cash payment is disallowed. Cash payment is disallowed. Now here one more adjustment is required. So here this is of course 80 double J double A is not applicable as cash payment of my salary. But here, if you look at, it says the company has employed new employees to whom salary paid was debited to the P&L account. So now salary is debited to P&L account, which is paid in cash, which is more than rupees 10,000. So will you not disallow the expenditure of salary? Yes. Yes, Namrata. They should work for 150 days. So in the next year, sorry, in the next year, they should work for 150 days. Here, for the salaries which are paid in cash, the salaries are also debited to P&L. So here, we will disallow the expenditure salaries in cash greater than rupees 10,000. So 11,000 into 25 employees for 2 months. This will be disallowed to me under the normal tax provision. What about under MAT? Whether under MAT also it will be disallowed? Yes. Under MAT, the cash disallowance will be given? No. Under MAT, there will not be any disallowances even if I make the payment for more than 10,000 in cash. So here under MAT, there will not be any effect. Whereas under 115 BAA, we will also disallow this. So we will increase our income here by 5.5 lakh. So 88 plus 5.5, 93.5 is my income over here. Whereas under normal tax, under 115 BAA, it will be 95.5. Are we clear with this? Yes. And now you will allow the deduction under 80 JJAA. What will be my deduction under 80 JJAA? It is 18,000 into 2 employees into 12 months into 30%. Isn't it? Because these two employees had joined in the last year in January. So in the last year, the deduction would not have been available because the employees were present for less than 150 days. But in this year, since they have stayed for more than 150 days, we will allow the deduction in this particular year for 12 months. So 18,000 into 2 employees into 12 months into 30% comes to 129,600. Whether you will allow this deduction under MAT also? No, Viraj, we will not allow this deduction under MAT. Under MAT, you will only allow the deductions which are available. Under MAT, there will not be any deduction available. So this is not available. How about under 115 BAA? Whether there 80 JJAA is allowed? Yes. Under 115 BAA, only 2 deductions are allowed, which is 80 M, 80 JJAA, and third also, sorry, 80 LE. Right? So therefore, here also 129,600 will be allowed. So my total income will be 92 lakh 20,400. My book profits will be 71 lakh. And here 9,420,400. Yes. Are we getting these amounts? Yes or no? Yes or no? We are getting these amounts or not? Yes. Okay. Is this clear? Any questions so far? Now, what will be my tax rate under normal provision? Yes, students, faster. Calculate the tax for me. Yes. 25 or 30, Viraj. What will be applicable? Here we do not have information about the turnover. Yes. So the company is incorporated in 23-24. So one can take an argument that turnover of the company for 21-22 was zero, and therefore tax rate of 25% can apply. Or you can also take an argument that the condition of turnover is not applicable as the company was not even in existence in 23-24. And therefore the tax rate of 30% can also apply. Right? So we have these two alternative set of arguments. We'll take 25% over here. Now, what about the STCG? So here you can write down tax rate 25% can apply by taking an argument that company was not in existence. Therefore, by taking an argument, company was not in existence. Therefore, turnover was of previous year 21-22 was less than 400 crores. So then in that case, how will be my tax rate determined? So on the income, which is other than my, so 9,22,400, out of that, if I reduce down capital gain of 10 lakh and royalties of 10 lakh. So this will be 7,22,400. On that, 25%. Alright? 1805 100. Alternatively, you can take an argument that alternatively one can consider tax rate at the rate of 30% as turnover was not applicable in 21-22 as company is incorporated in 23-24. Fine. So then in that case, we will consider here 30%. So either of these cases, 2166120. Right? Now, on royalties taxed under section 115 BBF at the rate of 10% on gross basis. So 1 lakh. STCG taxed under section 111A at the rate of 15%. So which is again what? 1.5 lakh. Fine. So my total tax liability will be 2416120, or if you go with 25%, 1805100, then it will be 2055100. Right? Now under MAT, my book profit is 71 lakh. So here MAT is at the rate of 15%. So 71 lakh into 15%, 10,65,000. Whether surcharge will be applicable under the normal provisions? No surcharge. Because total income less than 1 crore. Under MAT also, there will not be any surcharge as book profits less than 1 crore. Right? But there will be for sure cess applicable at the rate of 4%. So here it will be, my total tax is 2137304 or 2512765. Fine. And under MAT also cess will be applicable, which will be 4%. So 11,07600. So if you see, my normal tax liability is greater than MAT. So therefore, MAT is not applicable. As normal tax is greater than my MAT. Now, if I come under 115BAA, there also my tax rate will be at the rate of 22%. On what amount? On excluding the capital gain and 115 BBF income. So on 720 to 400. So on that 22%, it comes to 1588488. Right? Tax on STCG under section 112A, sorry, 111A, 1.5 lakh at the rate of 15%. Tax on royalties at the rate of 10% under 115 BBF is 1 lakh. So my total tax liability here will be 1838488. But here, sorry, 1838488. But here my surcharge will be applicable because under 115 BAA surcharge is 10%. So here surcharge at the rate of 10% will be applicable on all the incomes, even 115 BBF, and 111 is short-term capital gain. So this will give me the tax rate of including cess 2103230. So if you see, this is far lesser than the normal tax value. So we will advise to go as per 115 because that is more beneficial. Yes or no? Fine. Is this question clear? Any doubts so far? Fine. Yes. Okay. So let's move further. Now we'll see one question. We are not going to solve in detail, but we'll see one question around the other comprehensive income. We'll see one question around that so that you have an idea as to how do we take that into consideration. Are we clear? So in that particular question, we will just see because then we will have to start with the other topics also. So if we solve that, the time will be lesser. So it's better we will just look into the question. Okay. So therefore, I'll just show you that question. So ABC Limited, an Indian company engaged in pharmaceutical formulation in Tamil Nadu, started adopting Ind AS with effect from 1st April 21. The following particulars are furnished for 31st March 2024. Book profits after adjustments of all the items specified in section 115JB amounted to 52.26 lakh, except for the adjustment of brought forward losses for the year ended 31st March 2024. So means the book profit is already given to you. Brought forward loss as per books of accounts is given to us for 2021, 21-22, brought forward loss, unabsorbed depreciation. The business loss of 4.6 and 1.75 have been deducted while computing the book profits under 115JB for 2021-2022 respectively. So my book profits have already been deducted in the earlier year. And if you look at in the adjustment over here, it is said that the NCLT has admitted the application under section 7 of IBC made by the financial creditor against the company for initiation of insolvency proceedings on 31st March 2023. So in that particular case, what we will do? We have to give then the effect of UAD plus brought forward losses both because this is a company which has gone for the insolvency proceedings. So then we will take into consideration the aggregate of both the brought forward losses plus the unabsorbed depreciation. But the question tells us that the UAD, that the brought forward losses have already been reduced in the book profits of those respective years. So therefore, in this year, again, we will not reduce the brought forward losses. What we will take into consideration is only the UAD of 2 years. Because the brought forward losses have already been reduced, so therefore, we will not again allow the reduction of the brought forward losses. We will only reduce the UAD. Because what is to be reduced is the aggregate of UAD and the brought forward losses. Clear? So therefore, we will allow the aggregate of UAD to be reduced in this year. So if we look at here the solution, I have reduced here 7.1 since business losses have already been claimed against the past years. So the UAD shall be allowed against the book profits of the current year. So that will be allowed as deduction. The particulars for OCI for the year ended 31st March 2024 is given. OCI that may be reclassified to PNL. Now, moment it says that OCI that may be reclassified to PNL, there is no adjustment for that. The adjustment is to be made for the OCI that is not to be reclassified to PNL. Isn't it? So if you see here, we have to make the adjustments for the items which are part of the OCI that shall never be reclassified to PNL. So we will not make any effect for the OCI that may be reclassified to the PNL. Are we clear? Yes. So you have to only make the adjustments for the OCI that will not be reclassified to PNL. Are we clear? Yes. Next is OCI that will not be reclassified to P&L. So for that, we need to make the adjustment. First is the changes in the fair value of equity instrument. So if you see, what did I say over here? No adjustment for notional gain or losses from investment designated at fair value. We don't need to make any adjustment for notional gain or losses which are designated at fair value. So changes in the fair value of equity instrument, we will allow the actual gain or loss when the equity instruments are disposed. At this stage, the notional gain or loss, if it is there under the OCI, we will not make any effect for that. For all others, deferred gains on cash flow hedges, deferred cost of hedging, share of OCI of other associates, remeasurement of past employment benefit obligations, for that we will make the adjustment. Again, revaluation surplus of assets, we will not make any adjustment. So here, no adjustment. Fine. So no adjustment for the revaluation. So therefore, for all the other items which are credited to OCI, we will add that. Which are debited to OCI and not reclassified to P&L, we will reduce that. So we'll reduce 4.1 and we will add back 7.25, 3.2 and 4.45. Fine. So if you see here, I made that particular adjustment. Then the transition amount as on the convergence date stood at 52.50 lakh credit balance, including a capital reserve of 8 lakh. An adjustment of 45 lakh relating to the transition difference in foreign operations. So what did I say? The transitional difference which is there. That for that purpose, 1/5 of the amount we have to take into consideration. Isn't it? But here, which is 52.50 lakh, which is there, this includes the capital reserve. So we will exclude that and we will also exclude the transition difference in foreign operations. So here what we will do is, if you remember, I told you just now that in case of the transitional item, we will not include, we will exclude translation difference of foreign operations as well as the security premium and capital reserve. So here you will reduce capital reserve plus transition difference in foreign operations. So that will give me 40 lakh. So 40 lakh, 1/5, 8 lakh will be allowed. So this, since this is a credit amount, here I will consider over here 8 lakh. Transitional difference 8 lakh. And with that, we will calculate our MAT liability. Yes or no? Are we clear? Any questions? Any doubt? Okay. So if there are no questions, I think we can take a break of 10 minutes and then we get back. Let's take a break of 10 minutes. Yes. Let's take a break. So let's move to the next topic that we have now. We'll quickly revise the other provisions in the assessment of various entities. And then, as I told you, that tomorrow's class, Saturday's class would be dedicated on the charitable trust. And we will revise it today itself if the time permits. But Saturday, we will solve one question on the charitable trust. Apart from that, we will also solve questions on the transfer pricing and we will revise the non-resident taxation also. Chapter 6A deductions is what we have to do. So all that revision and the sum solving will complete by Saturday. We'll dedicate some part even on next Tuesday for the sum solving and the balance we will for 1 hour maybe, and then for the balance part we will just do the recent updates which are there. So we are left with now 2 more classes after this. Okay. So we'll start with the revision of assessment of various entities very quickly. We have buyback tax under 115QA, which is chargeable in the hands of domestic company on the buyback of shares. Remember, I told you in the last class while we were dealing with capital gains that in case there is buyback of shares by other company other than the domestic company, then in that case, their shareholders need to pay tax under 46A. The capital gains will be chargeable. In case the buyback is of ESOPs, then also the chargeability is in the hands of the shareholder under 46A. It will not be in the hands of buyback tax will not be applicable in the hands of the in the hands of a foreign company or in the case where the ESOPs are bought back. But in case of buyback, in the case of buyback by a domestic company, then it is chargeable in the hands of domestic company in the 115QA. The tax is 23.296%, which is 20% tax plus 12% surcharge and cess of 4% on the distributed income. So what is the distributed income? It is the consideration paid by the company on buyback minus amount received by the company for issue of shares. That is to be determined by Rule 40BB. And Rule 40BB gives the different scenarios as to how the amount has to be determined. For example, on the subscription, the amount received on subscription, including the security premium. In the case of ESOPs, the FMV of the shares is the amount received. On amalgamation, the amount received by the amalgamating company. In the case of demerger, it is similar to 49(2)(c), how you calculate the cost of acquisition. And similarly for the shares of the resulting company and the demerged company. Then it is basically the amount received by the demerged company in respect of original shares into net book value divided by the net worth of the demerged company. Then in that particular case, or for the if the shares are given for acquisition of assets, then it is A divided by B, where A is the FMV of assets and liabilities into consideration paid by shares divided by total consideration. And B is the number of shares issued. On succession or conversion, it is the book value of assets minus book value of liability divided by number of shares. On bonus shares, it will be nil. And on conversion of debentures of preference shares, it is the amount received for such debentures or the preference shares. Fine. Then we will move to the next part, which is the tonnage tax scheme. Tonnage tax scheme is applicable to an Indian shipping company or a foreign company having the place of effective management in India. So it is basically applicable to a resident company. It is applicable to the arrangements of chartering, but excluding the bareboat charter for more than 3 years or bareboat charter come demise in that particular case. So bareboat charter come demise is basically like a finance lease option. So basically you get to purchase the ship at the end of the period. So there are 2 arrangements in the shipping business. One is the charter arrangement. Second is the bareboat arrangement. What does the bareboat arrangement means? So bareboat charter agreement is basically an arrangement for hiring of ship. Bareboat ship is basically is an arrangement for hiring of ship or boat. And in that particular case, you can get the ship on the lease, right? That is the bareboat arrangement. So without the any crew members forming part of the ship. Okay, so that is in that particular case, tonnage tax scheme is not available. Are we clear? In that case, the tonnage tax scheme is not available in case we hire the ship on bareboat basis. Bareboat meaning the empty ship that I am hiring. In that case, there is no tonnage tax scheme applicable? It is applicable in the case of hire when I hire the ship along with all the amenities and the crew members of ship. So it is available in case of chartering of ship. Chartering means basically hire, but if I do a bareboat charter is basically I just take a ship on rent without its crew members, then tonnage tax scheme is not available. So the company should be a shipping company engaged in the operation of ships and should own at least one qualifying ship. There are certain exclusions, for example, sea-going vessels if used for goods or services, fishing vessels, factory ships, recreational ships, ferries, offshore installation, those are not qualifying ships. Then computation of tonnage income will be the income dependent on what is the qualifying ship having the net tonnage. And based on that, the amount of daily tonnage income is given. So there are slabs given as per which you have to calculate the tonnage income. Are we clear? Yes or no? So this is what the tonnage tax scheme suggests. There is a depreciation also available, but no other deduction is allowed in the PGBP. It is deemed that the deduction has already been allowed. So it's like a presumptive scheme income. No Chapter 6A, no set of carry forward of the business loss. And here, remember, MAT is also not applicable. Here, MAT is also not applicable. Are we clear? So this is the tonnage tax scheme. Then we have the assessment of the partnership firm or the LLP. So in case of the assessment of the partnership firm, share of the profit is exempt in the hands of the partner under 10(2)(a). Tax in the hands of the partnership firm is at the rate of 30%, surcharge is 12% if the total income is more than 1 CR and cess is 4%. Remuneration is allowed as deduction if it is as per the provisions of 40. Up to 3 lakh 90% or 1.5 lakh, whichever is higher, and on the balance is 60% of the profit. Then interest is allowed up to 12%. Remuneration and interest will be taxable in the hands of partner under 28(5). But what is here important is to be assessed as a partnership firm as such. You should have an instrument of the partnership firm and the shares of the partners shall be specified. Now, set off of losses. If there is change in the constitution of firm, then the share of the retired partner or the partner who has died will not be allowed to be carried forward. So in case there is change in the constitution of the firm, here change in the constitution means when there is a retirement of a partner or a death of partner. Change in the profit sharing ratio does not mean there is change in the constitution of the firm. So then in that case, the share of the retired or the partner who has died will not be allowed to be carried forward. That shall lapse. But this share of retired partner or the partner who has died, deceased partner, is the share in the business losses, not in unabsorbed depreciation. So unabsorbed depreciation can still be carried forward. Are we clear? In case there is dissolution of partnership firm, or there is change in the constitution of partnership firm, or there is succession. So if there is change in the constitution of the partnership firm, now here for this purpose, the constitution will also include change in profit sharing ratio. So if there is retirement of any partner, admission of any partner, or if there is change in the profit sharing ratio, then the assessment will be made on the reconstituted firm and not on the old firm. In case there is succession of the firm by another firm, then the separate assessment will be made on the old and the new firm. However, the liability of the partners shall be joint and several. If the partnership firm is dissolved or discontinued, then the firm will be assessed as if it is not dissolved. And the partners who were there at the time of dissolution will be liable jointly and severally. So this is the assessment of the partnership firm. Now going to the AMT, what we had to discuss, AMT is there under 115 JC. The applicability was on any person other than a company who is claiming the profit linked deduction under Chapter 6A. What profit linked deduction? Chapter 6A Part C relating to the income. 10AA ATIA, ATIB, ATIAC, all of those deductions, or under 35 AD. And if my adjusted total income is more than rupees 20 lakh, then the AMT will be applicable at the rate of 18.5% of my adjusted total income. Here it is not on book profit, it is on adjusted total income. And here it is 18.5%. For IFSC unit, it's 9%. So what will be my total income? Total income, adjusted total income is total income. Add any deduction which is claimed under Chapter 6A, Part C, which is in respect of income, which is ATIA to ATRRB, excluding the deduction under ATP. If you have claimed ATP as a cooperative society is allowed in ATP deduction, for them AMT is not applicable. Add deduction under 10AA, add deduction under 35 AD, which is for specified business, minus a notional depreciation, which is available under 30. So that will give me my adjusted total income. Again, your adjusted total income will be deemed to be total income. So all the advanced tax provisions, interest under 234BC will be likewise applicable. AMT will not be applicable if an individual is paying the tax as per 115 BAC, meaning the default tax regime, or a cooperative society is opting for 115 BAD or BAE regime. Also, just like the MAT credit, your AMT credit is available. If you are paying as per AMT, then the difference between the normal tax and the AMT will be allowed to you as credit for 15 assessment years. Are we clear? So if you look at here, this example that we have given over here, we'll look at one example over here to understand the AMT provision, and then we'll move further. Fine. So Mr. Roy was engaged in the business of cold storage and he has earned the net profit of 105 lakh during the previous year 23-24. The particulars are given. He incurred the capital expenditure 80 lakh for food grain, 60 lakh for sugar, 50 lakh for edible oil. So in this particular case, since he is engaged in the business of the edible oil, here he would get a deduction which is available to him. Isn't it? So here, no, sorry, not edible oil, the food grains and sugar. So here what we will do is we'll take the net profit which is available to us, which is 60 lakh and 14 lakh specifically, which is there for different businesses. So the 105 lakh is the total net profit, but they have given us the breakup. The profits from the cold storage has the following information. So cold storage of food grains is 60 lakh, cold storage of sugar is 14 lakh, and cold storage of edible oil is 31 lakh. So we'll take that into consideration. 60 lakh is the net profit for food grain and sugar is 14 lakh, right? Then in that particular case, what other information is given over here? They have said that he has incurred the capital expenditure of 190 lakh. So the food grain and the sugar business is a specified business. Maintaining a cold storage facility for food grain and for sugar is a specified business, wherein you will get a deduction under 35 AD. So you will get the capital expenditure prior to the commencement of the business. If it is capitalized, then you will get the deduction. So here 80 lakh is for the food grain and 60 lakh is for the sugar. So you'll get that. But here this capitalized amount which is there, it also includes the cost of land. So if you remember, I told you in the 35 AD, you can get the deduction of the capital expenditure prior to the commencement of business if you have capitalized, but excluding the goodwill, excluding the land. So in that case, 50 lakh is the purchase for land. So we will reduce that. So 30 lakh is what the deduction will be allowed. 40 lakh is for sugar. So then 20 lakhs will be allowed to me as a deduction out of 60 lakh for the prior period expense. Then what other information is given? During the year, he also incurred the capital expenditure for extension or reconstruction of building purchase. 20 lakh for food grade, 15 lakh for sugar. So again, we will allow that also. So that will give me the net profit, which is taxable after 35 AD. So here in the sugar business, we have a loss. So the loss will be set off against only the income from specified business, which is the cold storage of food grain. This loss cannot be set off against the normal business income, isn't it? So this 11 lakh loss will be carried forward to the next AY for indefinite period. For indefinite period, this can be carried forward. Are we getting that? Now, During the profits from the cold storage are given. During the year, he has also earned some salary of rupees 20 lakh for managing the cold storage of ABC Private Limited. So he has the salary income. We will take 20 lakh as a salary. We will first assume that if we go as per the normal tax provisions or the old tax regime opting out of 115 BAC, we will have the standard deduction of 50,000. Even if we go as per 115 BAC default tax regime, standard deduction will still be available under that, isn't it? Then in that particular case, he has also contributed to LIC, tax saving, medical premium, that all we will take into consideration. He also has the self-occupied house property which he had taken on loan. The interest on loan is rupees 3 lakh. Storage of agricultural produce is eligible under 3580, can be claimed for food grains and for sugar. Storage of edible oil is not eligible, isn't it? Now, loss under IFHP on the self-occupied property is 3 lakh. We will restrict it to 2 lakh. Here, loss under the self-occupied property for 115 BAC will not be available. Right? Only for the rental property it is available under 115 BAC. For the self-occupied property it is not available. Then, for the PGBP purpose, my total profits are 31 lakhs, right? Out of that, I will give the depreciation on building, right? Because for the oil business, I have not claimed 35. So I will claim the depreciation on building, which is allowed, isn't it? So for the oil business, there is no 3580. So in that particular case, what I will do is, so if you see under the oil business, I have the building amount given over me here. So here they have said he has incurred during the previous year for the construction or the extension or the reconstruction of building, he has paid 10 lakh for oil business. So in that particular case, I can get the depreciation over here. I can get the depreciation over here plus on the previous year's amount also. 50 lakh was for edible oil. So he had incurred a capital expenditure on purchase of land and building, which is 50 lakh for edible oil. So again, out of 50 lakh, 30 lakh is on land. 30 lakh is the land price. So on 20 lakh of the past year and 10 lakh of the current year, I will claim the depreciation on building, which is 10%. And I have the net profit which is given to me, which is 31 lakhs. So I will take that. Balance, we have a specified business loss, which we will carry it forward. So this will give me my GTI. I will claim the LIC deduction, ATD, medical premium. And based on that, I will compute the tax as per the optional regime. Under the 115 BAC, I will claim the depreciation again. There is no problem in claiming the depreciation. It is the problem in claiming additional depreciation. But here I cannot claim the chapter 6A deduction. And I will come up with the tax under 115 BAC. Here, since my total income is exceeding 1 CR, I will have here the surcharge becoming applicable at the rate of 15%. Surcharge becoming applicable at the rate of 15%. And based on that, I will compute my tax liability. That which one is beneficial. Also now, we will have a computation of AMT over here. So total income we have, which is the total amount of income. Add back the 3580 deduction minus notional depreciation. So what is my 3580 deduction? It is 85 lakh, the capital expenditure deduction that we are getting, minus the notional depreciation on that 85 lakh, which is 10%, because it's a building amount, right? So that amount we will add back and we will calculate the adjusted total income. And on that, since this is also exceeding 1 CR, we will have a surcharge and cess applicable. So if you go as per the normal tax or the old tax regime, you will have a surcharge. You will have the AMT applicable because AMT is greater. Are we getting it? So here we will get the AMT credit, which we will carry forward for 15 assessment. So it is beneficial. We go as per the normal tax provision, which is 115 BAC. If you go as per 115 BAC, the AMT will not be applicable. then in that particular case, it is 3695 640. But if you go as per the old regime, AMT will be applicable, but AMT is also lesser than 115 BAC, so it is beneficial to opt out of 115 BAC. Is this question clear to you, students? Yes or no? Yes. I have discussed this sum in greater detail in the last May 24 batch class. So if you want a detailed recording of that, you can just go back and look at that class. Here we are just quickly revising, and you're expected to watch those lectures and then come for this class, because that is how you will be able to revise. Yes, any questions so far? Yes or no? Anything not understood, you can please ask. Yes. Are we clear? Yes or no? Okay. So then we move forward. So then we are coming to the AOP and BOI. Now AOP and BOI, AOP is basically co-owners coming for some common purpose or effort to earn the income. BOI is the body of individuals. AOP can have even a company as a part of the member of AOP. Now the exception to that is section 26 of income from house property, which says that income of co-owners of house property will not be assessed as AOP. So co-owners of the house property will not be assessed as AOP. Now tax rate for AOP or BOI is same as individual. You have the default tax regime, which is 115 BAC. You have concessional tax regime. You have the optional tax regime, which is the normal tax rate. Interest or remuneration by the AOP to its members is not allowed as deduction. So unlike partnership firm where the interest or remuneration is allowed as deduction, here interest or remuneration is not allowed as deduction. The exception is if you pay the interest in the personal capacity or interest is paid on behalf of any other person. Because if you pay the interest in personal capacity, you're not paying it them as a member of the AOP, or you are paying on behalf of another person who is not the member of AOP. Now, how does the computation of tax work? So if the shares of the members is known, if the shares of the members of AOP are known, and if any member has the other income other than the share of the AOP or BOI greater than the basic exemption limit. What is my basic exemption limit? If I go for the default tax regime 115 BAC, basic exemption limit will be 3 lakh. Otherwise, it will be 2.5 or 3 or 5 lakh depending on the age of that member. Then in that case, you have to again see that whether any member is taxed at a rate higher than MMR, higher than the maximum marginal rate. If no member is taxed at rate higher than the MMR, then AOP has to pay tax at MMR. However, let's say for example, if the MMR is maximum marginal rate is 30% plus surcharge plus cess, right? So if any member, let's say for example, there's a foreign company which is a member of AOP, which is taxed at 40% plus surcharge and cess, which is greater than MMR, right? So 40% is obviously greater than MMR. Then the portion of the income which is attributable to that foreign company will be taxed at a rate, higher rate, which is 40%, which is applicable to that member. And the balance income will be taxed at MMR. So the member who is taxed at higher rate, his tax will be at that rate. For the balance income, it will be taxed at MMR. However, if the no member has any other income greater than the basic exemption limit, then AOP will be taxed as per section 115 BAC as the default tax regime or as per the normal tax regime if you opt out of 115 BAC. So only when any member other than the, if any member has the income from AOP or BOI other than his share, which is more than the basic exemption limit, then you will have to pay the tax at MMR if the shares of the member is known. If the shares of the member is unknown, Again, you will see that whether any member is taxed at a rate higher than MMR. If yes, then the total income of the AOP is to be taxed at higher rate, which will be, let's say, 40% plus surcharge plus cess. Why? Because here the share of the members are unknown. So we cannot segregate between that what is the share of that member who is taxed at higher rate and what is the balance income which is there of the other members. And if no member is taxed at a rate greater than MMR, then AOP will be continued to be taxed at MMR. Now, in terms of the member, this is the taxability in the AOP hand. So the share of the member will be exempt in the hands of the member under section 86. Also, if you remember in the MAT, I told you MAT is not applicable if a member is a company. So in case the AOP is already taxed at MMR, then again, if the member is a company, MAT will not be applicable on the share of the income from the AOP, because that share of member is exempt under 86. So even the MAT will not be applicable. Are we clear? In case where the shares of the members are known, and whether you have any member being taxed at greater than MMR or taxed than lesser than MMR, right? So whether or not you have any member who is getting taxed at greater than MMR or lesser than MMR, if you have any member who has other income greater than basic exemption limits. Now, AOP is paying the tax at rate higher than MMR or at MMR. So, the share of the member will be exempt in his hands under 86. Again, here, the MAT will not be applicable. Are we clear? However, if the member does not have any other income other than the share from AOP or BOI greater than basic exemption limit, then AOP is taxed either as per the old provision, old tax rates, or as per the 115 BS, meaning at the slab rate. Now, member he will receive the income or will receive the share from AOP. So, member's share will include the share which is received from AOP. Member's share will be included in the total income. And then the rebate will be allowed under 160. So first, we will include the share of the member and then we will allow the rebate. Are we getting that? So, if the AOP is paying the tax at the slab rate, then in that particular case, you will be, when you as a member are receiving the share from AOP, that will be included in the total. Now here, for calculating the MMR, what is the surcharge? If you go as per the default tax rate, the highest surcharge is 25%. If my total income excludes dividend, capital gain, 112, 112A, all of those income, it's 25%. Under default tax regime, 115 BS. Under the optional provision, the highest surcharge is 37%. However, if the total income only includes dividend, capital gain under 112, 112A, 115AD, then the surcharge will be maximum 15%. Or if the AOP has only companies as member, then even if the total income is more than 1 crore, the maximum surcharge will be 15%. So see, the surcharge will depend on, for calculating the MMR is 30% plus surcharge plus cess. So for calculating the surcharge, you will have to find out what is the maximum surcharge, whether you are going as per the default tax regime, whether you are going as per the optional tax regime, or you have the dividend, capital gain, or you have only company as member. Are we clear? Now, in the case where the AOP or BOI is taxed at slab rates, where the member's share is known, but no member is taxed, no member is having the income other than the share of AOP exceeding the basic exemption limit. Then AOP or BOI has to pay the tax at the slab rate or at the individual rate. Then when the member will receive the share, as I said, the share will be taxable in the hands of the member and the rebate will be allowed. Now, how the rebate has to be calculated? So first you take the share of the member from AOP or BOI, excluding the interest remuneration, right? And that share you will apportion under different heads of income in the same manner in which AOP or BOI has determined the income. So let's say the share is rupees 100 and the AOP's income was, let's say, house property income 80, 20 was PGBP. So you will also put that in two heads. 80, let's say your share is 100. So 80% will go to house property and 20% will go to PGBP. Now you will add the interest, bonus, remuneration, commission. You will reduce any interest on loan that you have taken to make an investment in AOP or BOI. This way you will arrive at the total income. You calculate the tax on total income. Find out the average rate of tax, which is the tax on total income divided by total income. Now your rebate under 1110 will be average rate of tax into share of member from AOP or BOI. You reduce the rebate and you will find out the tax. So this is how the tax has to be calculated in case of the AOP or BOI. Any questions? Any doubt? Is this clear? Yes or no? Fine. Okay. Now we move to the cooperative society. Now again the tax rate for the cooperative society we have already discussed. There are normal slab rates for the cooperative society. Then you have 115 BAE, which is 22%, and 115 BAD, which is 15% for manufacturing cooperative society. Plus, you get a Chapter 6A deduction under ATP if you go for 115 BAE or 115 BAD concessional tax regime, you don't get the deduction under ATP. Now, deduction under ATP is 100% of the profits which are arising from the business of banking or providing credit facility. If you're in cottage industry, marketing of agricultural produce, agriculture implements, processing without the power, or labor societies, fishing activities, so then entire profits are exempt. In case of cooperative society which is engaged in supplying milk, oil seeds, fruits and vegetable, again there the 100% of profits are exempt. In case of the other activities, deduction in respect of other activities on business income which is arising from those activities. If you do the other activities other than 1 and 2, then in case you are a consumer cooperative society, you get deduction of 1 lakh. Otherwise, other cooperative societies will get 50,000. Interest or dividend from investment in any other cooperative society, 100% exempt. Or deduction will be allowed under 80. Letting out of godowns or warehouse, 100% deduction will be allowed. Interest on securities or income from house property where the gross total income is less than 20,000. In case of cooperative society which are not housing societies, 100% deduction is allowed. Then ATPA is available to producer companies whose turnover is less than 100 crores, who are into the business of agri-produce, marketing, purchase of agricultural commodity, processing of agricultural produce. Entrance fees which is received by the cooperative society from its members. Then in that particular case, that is considered as PGBP. Right? But entrance fees which is received from members is governed by the principle of mutuality, that one cannot profit from oneself, therefore it is excluded from the income. Right? So entrance fees, membership charges, all of that are not considered as income because these are not taxable on the concept of mutuality. The expenses also are not allowed as deduction, but if there is any deficiency which is there, so we have already discussed under 44A, half of the total income will be allowed as deficiency. Right? But in case you are earning the interest income from the surplus funds that you have deposited with bank, that is not covered by the principle of mutuality, that shall continue to be taxed under income from other sources. If it is a specific activity, you are renting a clubhouse, you are renting a gymkhana, then in that particular case, it will be considered as PGBP under 28.3. So income minus expense will be considered as income under 20. Yes or no? Are we clear? Any questions so far? Yes. Yes, students, any doubt, any questions? Is cooperative society very, very clear? I need answers. Yes? Okay. So if there are no questions, no doubt we move to the assessment of the trust. If you have any questions, please ask me. Yes. If not, we'll straight away move to the taxation of the trust. I'm not getting any answers. See, this is students going to be little faster for the reason that these are problem solving classes and the revision classes and not your regular classes. If you have any concept which is unclear, you can please ask. But for the detailed classes, you have to go back to your May 24 recordings. If you do not go through that and you just sit for this class, you will not be able to follow properly because these are revision classes. This is to revise everything that we have done so far. The detailed classes will continue to hold good of May 24 attempt. So if you have any questions, please write to me in chat box or send it to me over the app. I'm getting all your questions and I can take those into consideration. Okay. Now coming to taxation of trust, there are different kinds of trust. The charitable or religious trust, we will talk about it in the second part. Private trust, political parties, securitization trust, alternative investment funds, and the REIT or InvIT. So first we'll cover the securitization trust, AIFs and REITs or InvIT, and then we will move towards the charitable trust. Now in case of securitization trust, what usually happens is that securitization trust issues the security receipts and collect the funding from investors. And it gives the funding to the bank or financial institutions on the pledging of the assets. So the bank or financial institutions will pledge the assets with the securitization trust and it will give the funding to the bank or financial institution. So usually what bank does is bank will give the loans to the borrowers, right? And will take the assets from the borrower. Now these assets, the bank will pledge again with the securitization trust and will get the funding. Now income of the securitization trust is exempt under 1023DA. It is a pass-through entity, meaning the income is not taxed in the hands of the trust, it is taxed in the hands of the investors. So income by way of interest from the bank or financial institution. So the bank, since it is obtaining the funding from the securitization trust, it will pay the interest to the securitization trust. This will not be taxable in the hands of the securitization trust since it's a pass-through entity. It will be taxable in the hands of the investors in the same manner and to the same extent as it is taxable in the hands of the trust. So the way trust will characterize that income, it will be same in the same manner taxed in the hands of the investor. Now, when the trust has taken the funding, has taken the loans from the investors, and trust pays interest to the investor, trust is required to deduct the TDS under 194 LBC. If it is making the payment of interest to the resident individual HUF, it's 25%. If it is others, resident others, then 30%. If it's a non-resident or a foreign company, it's at rates in force. Rates in force means the rate under the Act or the DTAA, whichever is beneficial. So that is for the securitization trust. It's a very simple concept that it is a pass-through entity. Income will not be taxable in its hands. It will be passed through to the investors. It will be taxable in the hands of the investors. Clear? Then we have the alternate investment funds. In case of alternate investment fund, again, these are considered as pass-through. Only for the other income, for the business income, these are considered as the taxable units. So for if the AIF has PGBP income, it will be taxed in the hands of the AIF. If it is company, then it is 30% or 25% for company. If it is a firm, then it is 30%. If it is others, it is taxed at the maximum marginal rate. If it is other income, then it is exempt in the hands of the AI. It will be taxed in the hands of the unit holder in the same manner and to the like extent. And when the AIF distributes the income to the unit holder, it has to deduct the TDS under 194 LBB for the resident unit holder, 10% for the non-resident unit holder at the rates in force. In case it's a PGBP income, since it is already taxed in the hands of AIF, it will be exempt in the hands of the investor. Now for losses, this is very, very important. For losses, if the AIF has PGBP loss under the head business income, then the loss will be carried forward and set off at the level of the AIF. Why? Because the PGBP income is also taxed in the hands of the AIF. It is not taxed in the hands of investor. So even the losses will be set off against the income of the business income of the AIF at the fund level. It is not allowed to investors. However, in case of other losses, if the units are held for more than 12 months, greater than equal to 12 months, losses allowed to be carried forward and set off by the unit. AIF cannot set off. If the units are held for less than equal to 12 months, then the losses cannot be set off and carried forward by the investors. The act is silent with regard to allowability of losses, even to the AIF. So act does not provide anything for the losses which are arising, other losses other than business loss, if the units are held by the investors for less than 12 months. So here I have given one example. So let's say for example, A, B, C, D are the 4 investment fund. They have business income, they have capital gains, they have income from other sources. Now it is given over here. Compute the total income of the investment funds and the unit holder, assuming that each investment fund has 20 unit holders, each having 1 unit held by them for a period exceeding 12 months. Income from investment in the investment fund is the only income of the unit holder. If the investment fund C has the following components, what would be the total income of the fund and the unit holder for that year? We'll see later. So first we'll talk about the A. Business income is not there in A. Capital gains and income from other sources is there. So in whose hands it will be taxable, students? Whether it will be taxable in the hands of A or in the hands of the unit holder? Yes. Yes, students, please faster. Yes. I'm waiting for your answer. So it will not be taxable in the hands of the fund because students here it is other income. So it shall be taxable in the hands of the unit holder. This 20 lakh divided by 20 unit holder, 1 lakh will be taxable in the ratio of 4:1. That is, the capital gain will be 80,000, income from other sources is 20,000 because it will be taxable in the like manner and to the same extent. Remember? Now you will ask me how the investor will get the information about that, how the income is taxed, how the income is broken up in the or the characterized in the hands of the AIF. AIF gives the statement. of the income, that okay, this is what the proportion of our income is. This is capital gain, this is this much, and this is the distribution. So you have to tax in your hands in the same way it is characterized in the hands of AI. Are we clear? In case of B, 2 is the business income. So 2 lakh will be taxed in the hands of B. The capital gain and income from other sources will be taxed in the hands of the unit holder. 18 lakh divided by 20 unit holders, 90,000 is what will be taxed in the hands of unit holder. In the ratio of 7:2, that 70,000 will be capital gain and 10,000 will be IFRS. The third case and fourth case is very interesting. Business loss is there, capital gain loss is there, and income from other sources. Now, business loss can be set off against the income from other sources, right? It is inter-head set off. Only then the income will be distributed. Capital loss cannot be set off, right? So, what you will distribute is only 6 lakh, right? So, 6 lakh will be distribution after setting off the business loss. So 6 lakh divided by 20 shareholders, 30,000 will be taxed as income from other sources in the hands of each shareholder. And 6 lakh will be allowed to be set off and carry forward. 6 lakh divided by 20 shareholders, 30,000 will be allowed to be set off and carry forward as the capital losses in the hands of the unit holder, since each unit holder has held the units for more than 12 months. In case of D, the IFRS loss will be set off first against business income. So only 3 lakh will be my business income. So 3 lakh will be taxed in the hands of AIF, and 20 lakh divided by 21 lakh will be taxable in the hands of the unit. Are we clear? Now if they say if the investment fund C has the following components for the next year, what would be the taxability of income in the unit holder and the AIF? So business income is 2 lakh. That will be taxed in the hands of fund. Capital gain is 9 lakh. So from this 9 lakh divided by 20, 45,000 per investor, minus 30,000, which is the loss brought forward from the earlier year. So 15,000 only will be taxable in the hands of the unit holder as capital gain, and 20,000 will be taxable in the hands of unit holder as the income from other sources, which is 8 lakh divided by 20. Yes or no? Are we clear about this? Yes. Fine. So this is the AI. Now, first we'll come to the concept of the REIT and InvIT. Okay. Now, in the case of the REIT or InvIT, what happens is, so usually there are sponsors of the special purpose vehicle. Special purpose vehicle is nothing but a domestic company. But it's just a holding company. That's why it's called as a special purpose vehicle. So the special purpose vehicle's owner will give the shares of special purpose vehicle to the REIT, and REIT in exchange will give the units of the REIT to the shareholders of the SP. So this is not regarded as transfer under 4770. Exchange of shares for the units of REIT is not regarded as transfer under 4770. So any gain or loss which arises on exchange, so gain or loss, it will be a notional gain or loss on the transfer of shares. This is also not to be considered for the purposes of the MAT. Remember, I just now told you, under MAT, any notional gain or loss on the transfer of shares for the units of REIT will not be considered in the book profit calculation. When you sell the shares of the, or when you sell the units of the REIT, when you sell the units of the REIT, at that time, whatever profit or loss will arise, that will be considered in the MAT calculation. So now what will happen when the sponsor of the SPV will give the shares to the REIT? REIT will become the holding, SPV will become a subsidiary, right? Now this SPV will hold the immovable property. That is why it's called as a special purpose vehicle. It's a holding company, holding some investments or some particular asset. So when you get the units of REIT, this is not regarded as transfer. When you sell the units of REIT, there will be either short-term capital gain or long-term capital gain. If it is a short-term capital gain, it will be taxed under 111A at the rate of 15% because these are listed. Units of REIT are always listed. If it is a LTCG, then it will be taxable under 112A only if it is more than 1 lakh. What will be the cost of units of REIT? Cost of the shares of the SPV, cost to the previous owner. Period of holding of the units of REIT will include the period of holding of the shares of SPV. And what will be the period of holding over here? 36 months. Will indexation be allowed? No. Under 112A, we don't get indexation. Remember? So no indexation over here. But the period of holding for long term or short term is 36 months. Are we clear? Now in the hands of the REIT, there could be multiple incomes. Now REIT can first have the income in the form of dividend from SPV. So if it is earning the dividend from the SPV, then in the hands of the REIT, this is exempt. Also, SPV, when giving this dividend to REIT, is not required to deduct TDS under 194. Now, this dividend will be taxable in the hands of the unit holder. Again, in the hands of the unit holder, you need to check whether SPV has exercised the concessional tax rate under 115BAA. If yes, only then dividend will be taxable in the hands of unit holder. If the SPV is paying the taxes as per the normal tax rate, then the dividend will be exempt in the hands of the unit. So meaning dividend will not be taxed in the hands of REIT as well as in the hands of unit holder if the SPV has not exercised the tax rate under 115BAA. Only when the SPV has opted for the concessional tax rate of 22% under 115BAA, dividend will be taxed in the hands of unit holder. In case of resident, it is a normal rate of tax. REIT is required to deduct the TDS on that distribution at the rate of 10%. If it is a non-resident, it will be taxed at the rate of 10% under 115. And the TDS will also be under 194 LBA at 10%. Are we clear? Now, in case REIT has given loan to SPV and SPV is paying the interest on that. So again, interest which is there will be exempt in the hands of REIT. Again, REIT is a pass-through entity. Also, the SPV is not required to deduct the TDS under 194A. It will be taxed in the hands of unit holder. If the unit holder is a resident, it will be taxed at normal rates. The TDS will be deducted by REIT at 10% under 194 LBA. If the unit holder is a non-resident, then the tax will be 5% under 115A. And the TDS will also be 5%. Are we clear? Now, other income, REIT can directly also invest in immobile property. So it can generate rental income. Now, the rental income which is generated by the REIT, that will be in the nature of income from house property or will it be in the nature of business profession? So you will have to refer back to the judgment of Chennai property case, right? In the case of REIT, the objective is to do the leasing of properties, right? So then it will be business income and not income from house property. So rental income again will be exempt in the hands of REIT. No TDS under 194I by the payer. For the unit holder, it will be taxable. The TDS will be under 194 LBA. For resident, it is 10%. For non-resident, it's at rates. No specific rate of taxation is given for the rental income in that case of unit holder. Any other income which is earned by REIT, if it is, let's say, LTCG under 112 and on the sale of capital asset, it will be at 20%. It will be taxable in the hands of REIT. STCG on the sale of shares under 111A, it will be at 15%, and any other income beyond this will be at MMR. And any other income will be exempt in the hands of the unit holder. Are we clear? Yes. And if REIT is, let's say, paying interest to any non-resident, then it will be taxable in the hands of the non-resident at the rate of 5%, and the TDS will be at the rate of 5% under 194 LC. If the borrowings by the REIT is listed, if the REIT is listed on IFSC and the borrowings is in rupee denominated bond, then the tax will be 9% under after 1/7/2020. Now, sum paid by REIT to unit holder as the repayment of debt or redemption of unit by unit holder, then it will be chargeable in the hands of the unit holder under 56(2)(12) under the head income from other sources. And what will be the taxability? It will be A minus B minus C. A is the sum distributed by REIT, minus B is the cost of acquisition of the unit, and C is the amount of tax under this section in any earlier previous year. If answer is negative, it will be 0. It will not be a loss situation in that case. Are we clear? Yes or no? Any questions? Any doubt around this? Yes? Okay. So you can solve this question from module also. Now we'll move to the trust. So in the case of the trust, there are two. First, we'll cover the private trust. Then we'll move to the charitable trust. So for the private trust, we have revocable and irrevocable trust. Revocable is that if the settlor has the power for retransferring the assets or income to the settlor, or it gives the power to reassume over the income or assets, then in that case, the income of the trust shall be taxable in the hands of the settlor only. If the transfer to the trust is for the benefit of spouse or for daughter-in-law, then it will be clubbed under section 64 in the hands of the transferor. Irrevocable trust is if the transfer does not derive any benefit directly or indirectly from the trust, or it is not revocable, then income is not taxable in the hands of settlor. Income will be taxed based on whether the trust is a specific trust or discretionary trust. If it's a specific trust, if the shares of the beneficiaries are known, and if there is no business income, then the share of beneficiary shall be taxable in the hands of the beneficiary at the slab rates. If there is a business income, then it will be taxable at the MMR. Are we clear? Exception to that will be that if the trust is for the benefit of relative. If it is a discretionary trust, then if there is a business income, it shall be taxable at MMR. In case there is no business income, then also it will be taxable at MMR. But the exception is that if no beneficiary has other income more than basic exemption limit, and it is beneficiary only in one trust, then it will be taxable like AOP. It will be taxable like AOP and not like trust. Are we clear? And in this particular case, in case of discretionary trust, it is taxable in the hands of trustee and not in the hands of beneficiary. Now moving to the charitable trust. Under charitable trust, there are two regimes, as I said. One is 1023C and second is section 11, second regime. Under 1023C, first regime, which trusts are covered? There are certain specific listed trusts where there is unconditional exemption which is given to them. Second are the educational institutions which are existing solely for educational purpose and which is wholly or substantially financed by the government. Second is hospitals which are wholly and substantially financed by the government. Again, there unconditional exemption is given. Unconditional meaning that you don't need to satisfy any condition. What is wholly or substantially financed by government? The government grants are greater than 50% of my total receipts. Third category is educational institutions existing solely for educational purpose. And if their annual receipts are less than rupees 5 crore. Now, educational institutions engaged solely in education means what? So, educational institutions shall be considered to be engaged solely in education and not for profit. That will be determined that whether the educational institution is engaged in any other business activities which are unrelated to the objective of imparting education. So solely here means that I should be completely relating to the education business. I should be only offering the education. I should not be doing any other business activity. If the institution carries out any other business activity, for example, they are running buses, they are offering textbooks, they are running libraries, but if it is that is incidental to the objective of education. And if I am maintaining the separate books of accounts for that incidental income, then I will be entitled for 1023C exemption even if I have certain profits from the incidental activities. And then those profits will also be exempt. Are we clear? So that is the meaning of educational purpose. Second is hospitals if their annual receipts are less than rupees 5 crores. So the combined receipt, if I am running a trust, one portion of one unit of that is doing educational activities, second is doing hospitals. So the combined receipts of both should be less than 5 crores. And finally, the charitable or religious institutions or educational institutions whose aggregate receipts are more than 5 crore, or if annual receipts are more than 5 crore, or hospitals whose annual receipts are more than 5 crore. Exemption under 1023C will be available subject to obtaining the approval and registration from PCIT or CIT. For the first three categories, which is the specified trust, for educational institutions or hospitals which are wholly or substantially financed by government, educational institutions which are solely for educational purpose, and hospitals which are not for profit are having the annual receipts more than less than 5 crore. These have unconditional exemption, meaning they don't have to comply with any conditions. But other than that, any other trust which is claiming 1023C exemption has to be subject to the registration and approval. Are we clear? Yes or no? Any questions so far? Okay. Now, second regime is section 11. Now, what do we understand by charitable purpose? Charitable purpose is defined under 250, which says relief of poor, education, yoga, medical relief, preservation of environment, preservation of monuments, and any advancement of any other object of general public utility. Now, what do we understand by advancement of any other object of general public utility? That I shall not carry out any activity in the nature of trade, commerce, or business. The exception is if the activities are undertaken in the course of advancement of the object of general public utility. That means these are the incidental activities. And the receipts from those activities from the trade, commerce or business is less than 20% of the receipts. Then it will be considered as advancement of any other object of general public utility. It will not be considered that I am doing any activity in the nature of trade, commerce or business. What if I have a trust having the objective of promoting yoga? And I have certain incidental income. So, if I maintain the separate books of accounts for my incidental income, there is no bar of having the receipts from the incidental income less than 20% of total receipt. This condition is only applicable for the advancement of any other object of general public. It is not applicable for all other charitable purposes. So only when I'm falling under the advancement of any other object of general public utility, I should not have the any other activity in the nature of trade, commerce, or business, even if I have my receipts from that activity should be less than 20% of total receipts, and that activity should be in the course of advancement of the any other object of general public. Clear? Now, what is the meaning of trade, commerce, or business? So, Supreme Court in Ahmedabad Urban Development Authority has held that you have to identify whether the markup on the cost is nominal or significant. If it is significant markup, then only I can say it is in the nature of trade, commerce, or business. If it is nominal, it cannot be in the nature of trade, commerce, or business. If it is a nominal markup and those activities are already incidental to the objective of general public utility and separate books of accounts are maintained, there is no problem. It is only when I'm charging a good amount of markup on the other activities that I'm doing, it can be considered as the trade, commerce, or business. And if it is in the nature of trade, commerce, or business, I need to check the exception that whether it is in the course of advancement of objective of general public utility and if my receipts are less than 20% of total receipts. Are we clear? Now,
from your calendar, say, be reading with harsha.ketwani@outlook.com. Starts.
okay. So, how do we ascertain the statement or make the statement of total income? So, income
Sorry, I'm not sure.
Sorry. So here, income derived from property held for charitable or religious purposes in India, you will consider while framing the statement of total income. Here, income will mean the gross receipts and not the net receipts. So here, when you take the income derived from property held for charitable or religious purposes in India, here you need to take the gross receipts and not the net receipts. You don't need to reduce the expenditure over here. Then you need to add the voluntary contributions. Other than one which are with the specific direction to form part of the corpus of the trust. Now, corpus donations are not considered as income provided they are deposited in the modes which are specified under section 11.5. 11.5 gives the different modes where the corpus donations could be deposited, which is in the government securities, bonds, and all of that. Corpus donations for repair or renovation of religious trust. Repair or renovation of the religious trust, or any donation which is given for repair or renovation of the religious trust will be treated as the corpus donation, provided it is applied for the purpose for which the donation is received. The amount is not given to any other trust as donation. And it is invested or deposited in the mode specified in level. So any donation which is received for repair or renovation of religious trust, then in that case, it will be considered as corpus donation, provided it is applied for that purpose for which it is given, or it is invested in the mode specified in 11.5, or it is not utilized for making the contribution or donation to any other trust. So corpus donation will be exempt in that case. It will not be taxable. It's a capital receipt. It's towards the corpus, towards the capital. However, if the religious trust violates these conditions, meaning it does not apply for, let's say, for example, it is given for renovation of temple. It does not apply. It does not apply for the renovation of temple. It, distributes that amount to feeding the poor. Or it gives these amount that is received for repair of the, let's say, mandir or temple. It gives these amounts to any other trust as donation. So then in that case, it is a violation of these conditions and then it will be considered as the deemed income. In that case, it will be considered as deemed income. Then income from government grants or subsidies will be considered as taxable. Then comes the anonymous donations. Now, anonymous donations which are there, you have to tax, you have to consider 5% of total donation or rupees 1 lakh. Whichever is higher, that will be considered as the taxable amount over here as the anonymous donation. So let's say, for example, if my total donation is 15 lakh and anonymous donation is 4 lakh, then 5% of total donation or rupees 1 lakh, whichever is higher. What will be 5% of total donation in this particular case? So total donation here means all the donations, including the corpus donation, including the anonymous donation. So 5% of my total donation or rupees 1 lakh. So 15 lakh, 5% or 1 lakh, what is higher? 1 lakh. So 1 lakh will be considered as the normal donation and 3 lakh will be considered as my anonymous donation. Are we getting that? So anonymous donation, there will be excess donation which is beyond this particular amount will be considered as the taxed at 30% under 115 BBC. So anonymous donations beyond these amounts, so 5% of total donation here means the corpus donation, voluntary contribution and the anonymous donation, all donations. 5% of that. So 5% of total donation, including the corpus or rupees 1 lakh. Whichever is higher will be considered as normal donation. Other than that will be considered as the anonymous donation. Are we getting this? So if my 15 lakh is my total donation, anonymous donations are 4 lakh. So 3 lakh if my normal donations are considered as 1 lakh because 5% of 15 is 0.75 or 1 lakh. 1 lakh is higher. So 1 lakh minus 4 lakh, 3 lakh will be taxed at 30% under 115 BBC. Balance 12 lakh will be subject to normal tax. Are we clear? And these are eligible for application of the income. Clear? Then any capital gain amount. Capital gain is what? Sale consideration minus indexed cost of acquisition. Sale consideration minus the indexed cost of acquisition. So then in that particular case, that will be considered as my income. Are we clear? So that will be considered as my income. Now this will give me the gross total income. Now how do we calculate the application? First you give the ad hoc exemption of 15%. Then balance 85% of income. There are different provisions for that. First is deemed application. Let's say for example, if I cannot apply my income, whatever application I'm actually making, I will be allowed that. But beyond that, let's say for example, if I'm unable to apply my income due to, let's say for example, I have followed the accrual system of accounting. However, income I have accrued, but it is not received to me during the year. So it will be considered as the deemed application for that year. For that purpose, the condition is that the income should be applied in the year in which it is actually received or in the next following previous year. So if, let's say for example, we are looking at 23-24, if I do not receive the income during this year, the condition is it will be considered as deemed application. It will not be considered my income. It will be considered as deemed application. I'll be allowed that as an application. However, the condition is I should apply the income, let's say if it is received in 24-25 in that year or in the year following that in 25-26. If I do not apply the income, either when it is received in that year or in the next following year, it will be considered as deemed income of 25-26, which is the next following year. And deemed income, there is a separate taxability under 115 BBI. Under 115 BBI, we will look at that. So if I have not received the income, I follow the accrual concept, I have the option of claiming it as a deemed income, and I have to exercise this option by filing the Form 10, which is to be filed 2 months prior to the due date of return of income. And plus, I have to also file the return of income under 139(1). Second is deemed application, where let's say, for example, income is received, but it is received maybe, let's say, in the month of March or maybe on 29th of March. Then also it will be deemed to be application. The condition is I should apply it in the next year. In the next year, not in the next to next year. Only when I have not received the income during the current year, I have an option to apply it in the next year or in the next to next year. But when it is received, it is already received, then maximum I have the option to apply that income in the next year. If not applied, again it will be considered as deemed income of the next year. Are we clear? Now, once this is already considered as income of this year, application of income, this will not be again considered as application of the next previous year, because this is considered as application in this year. Are we clear? Then 85% of the income, if I'm accumulating for the specified purpose, let's say, for example, I'm accumulating the income towards corpus, that I would, construct a school over here. So I'm accumulating the income for a specified purpose. I can consider it again as an application, deemed application for the current year, if it is for a period of less than 5 years and if I file the Form 10. Now again, the due date of submission of Form 10 is 2 months prior to the due date of return of income. However, the CBDT circular is clarifying that even if you do not submit the Form 10, even if you do not submit the Form 10 on or before the due date under 139(1), then the benefit of accumulation is not available and the income will be taxable. So even if you do not submit 2 months prior to the due date, but if you submit it before the return of income is filed, you will get the benefit of accumulation. But if you do not submit before the return of income is also filed, then in that case, it will not be considered as the deemed application and your income will be taxable. Are we clear? So 85% of income, if you want to accumulate for specified purpose for a period of less than 5 years, you have to file Form 10. And it will be considered as deemed application for current year. However, this amount should be deposited in the mode specified in 11(5) and you have to file the return of income on time. Are we clear? Now, if you violate the conditions, again it will be considered as deemed income. Now, what are the violation of the condition? If you apply the amount which is accumulated towards the purpose which is other than charitable, religious, or against the object of trust, then it will be deemed income in the year in which the condition is violated. Or if you do not accumulate the amount, you just spend the amount itself. So in which year in which the amount ceases to be accumulated, it will be considered as deemed income. Or the amount is not invested, or you just withdraw the amount from the modes which was specified in 11(5). Then in the year in which ceases to be invested, it will be considered as deemed income. Or if the amount is not utilized for the purpose for which it was accumulated. I said I would construct the school, but I am just again feeding to poor. Then I have been allowed to accumulate this amount for a specified period. 2 years, 3 years, 5 years. So the permission which I have taken by filing Form 10. So the last previous year for which it was to be accumulated, in that last year, it will be taxable. If it is not utilized till that year, let's say I've said that within 3 years I have constructed a school. So in the last year, in the third year, if the amount accumulated is not utilized, then in the third year, it will be deemed to be the income of that. And this will be taxable under 115 BBI. Or if it is credited or paid to any other trust. Are we clear? So deemed application is in the case when, let's say for example, if you do not receive the income or you receive the income late, you have to file Form 10. Or if you accumulate the amount for specified purpose for a less than 5-year period, then you also have to file Form 10. But then there is a CBDT circular which says that even if you do not file the Form 10 before the due date of 2 months prior to the due date of return of income, you can still file by the due date of return of income. That option is not there in the case of deemed application where the income is not received or received late. In those cases, you have to still file the Form 10 2 months prior to the due date of return. Then expenses are allowed. So all the operational expenses will be considered as your application of income. So expenditure allowed only when actually paid, irrespective of whether you follow the accrual method or the mercantile method. For income, even if you do not receive, we are still giving you the deemed application. But for expense, it is saying only when you actually pay, you will be allowed as expense. Here also you have 40A, 1A applicable if you do not deduct the TDS or deduct but not paid before the due date of 139, 30% will be disallowed. It will be considered as application in the year in which you pay the TDS. Cash expense more than 10,000 is not considered application. Expenditure incurred but not paid during the year. Again, mercantile system, if you follow, you will not get the expenditure as the application. Capital asset, if you acquire, that is also application of income. You will not get depreciation on capital asset because you are considering the capital asset itself, so we will not give the depreciation. Repayment of loan or borrowing. If I repay the loan or borrowing, that will be considered as application. What are the conditions? Loan should not be utilized for the corpus donation to another trust. Loan should be applied in India. TDS should be deducted on any expenditure paid through the loan. Expenditure which is paid through the loan should not be in cash more than 10,000. Application of the loan amount should not be for the benefit of any specified person. Repayment of loan should have been made within the 5 years from the end of the year in which application was made from the loan. Are we clear? So, if you, let's say for example, you have taken the loan and of 10 lakh and from that I am paying the salaries of 3 lakh. So that 3 lakh, the application from the loan borrowed is not considered as application. Only when I repay that 3 lakh or I repay the 10 lakh, I will be given the application of income. Income deposited in modes specified in 11.5, which is maintained for corpus. Again, if I deposit in 11.5 modes, I will be considered as application of income. If I withdraw the amount from corpus, that will not be considered as application of income. Are we clear? So if I withdraw the amount, that is not considered as application of income. Right? But there are conditions that, again, this should not be, this income should not be utilized for the corpus donation to other trusts. It should be applied in India. TDS should be deducted on the expenditure. If I am doing any expenditure, that is for loan for sure. But for the income deposited in any mode, what are the conditions here? That this should not be utilized for corpus donation to any other trust. It should not be for benefit of any other person. Are we clear? Then donation to any other trust, if it is registered under 12AB or 23AC, irrespective of the objective of that trust, shall be allowed only to the extent of 85% of amount donated. The amount donated should not be towards the corpus or donation out of the accumulated income. If I have accumulated the income for a specified purpose and I am giving the donation to any other trust, will result in violation. But generally, if I am making donation to any other trust which is registered, irrespective of its objective, will be allowed to the extent of 85% of the amount donated. Are we clear? In case of capital gain, if the sale consideration is reinvested for acquiring the new asset, it will be considered as deemed application. The capital gain amount is considered as deemed application. If the part consideration is reinvested, then the application will be the cost of the new asset minus the cost of old asset. Fine. So with this, we'll stop here. In the next class, we will do a sum on the charitable trust. Fine. So I've quickly revised the entire charitable trust and all the other trusts that we have. So the next class, we'll do the sum on the charitable trust and on the transfer pricing provision. So I request you to please revise transfer pricing, chapter 6A deductions and the trust concept so that we can do the sum in the next class. So thank you so much. Yes, we can close the session.